So 2 questions I get a lot, especially when the initial loan paperwork goes out. Number 1, why did my interest rate go up so much? Or 2, a slightly different version of the same thing, why is the interest rate and all the stuff on the paperwork so different than I was told over the phone? What the real question on that is a common one, and that is, what the hell is APR? First of all, let's define interest rate, something totally different than APR. The interest rate is the fee that the bank charges you for borrowing the money. Last month you had a loan with them. At the end of the month, you owe them a little bit of principal and the interest that's due. That fee, that charge, is the interest rate on the money that you're borrowing. So APR is not the same thing. APR is a way to calculate the cost of the loan and the cost of getting the loan over the first year. So not only does APR include the interest that you're paying on the loan, it also includes the other costs. The other costs could be discount points, loan origination fees, processing fees, underwriting fees, a wide variety of fees charged by the lender that are associated with getting the loan. So when there are costs incurred to get a loan, the APR is always higher than the interest rate. On the other hand, if you get a true no-cost loan, where the lender charges nothing, no fees of any kind, in that case, the APR and the interest rate should be almost identical, if not exactly identical. The other thing to know about APR is because it's calculating the costs incurred to obtain the loan, typically there's no costs once you already have the loan. So the APR and the interest rate starting on the second year and thereafter for the remainder of the loan should be exactly the same. So why did they come up with APR? The purpose was to make it easier to compare loan offerings and lenders and the costs to get the loan themselves. Here's the problem. Every lender uses different calculations. So it started out to be a good idea. Hey, if we got an APR from lender A and B and C, we can just compare all 3 and figure out which loan is actually the better deal. It doesn't exactly work like that because every lender may just use a slightly different calculation or different fees or not include certain fees. So the APRs aren't exactly an apples to apples comparison. So here's an alternate. Definitely, when you're shopping for a loan, get the APR. But there's a second thing that you can do when shopping loans in order to compare not only interest rates, but APRs, but also lender, and that is this. Number 1, get a rate quote from a lender. Make sure you specify that the loan you're wanting a quote on is for a purchase or a refi. How much equity do you have? What's your down payment going to be? What are your credit scores? And then also ask them how long of a lock period is that rate good for. Number 2, get the lender's lists of fees. The fees could be discount fees, origination fees, underwriting fees, processing fees, any other lender fees. So once you have those things, if you have an interest rate that's based upon the exact same calculations, and then you know what all the various different lender fees are, then you can compare them. Also, since I did my first loan 32 years ago and still have my NMLS license, lender is a language that I speak. You can call me and I can help you walk through that to shop lenders to really see the deal that you're getting. You can call me at 949-413-2371. You can email me, michael@houseofgroup.com. Or also, if you click on this letter I that's been sitting here over my shoulder, if you're watching this on YouTube, that will take you to a landing page. We can set up a strategy session and I can help you think through the mortgage loan, the APR, the interest rate, and the costs, and the comparison shopping. Thank you for watching.